Imagine this, making massive returns on 8 specifically selected ETF mutual funds by timing the market perfectly in the last 4 months without any downturn. I did this, and today I will reveal those 8 ETFs so that you can do the same while they're still hot. And if that's not enough, hold on till the end for some exclusive secret information that's not readily available anywhere else, which can help you navigate the investment waters with unmatched precision. So without wasting more time, let's get into these 8 investments that gave me a whopping 14% growth in the last 4 months. The first ETF mutual fund that I invested into was FCPIX, Fidelity Advisor International. Now this fund, along with all of the investments that I'm listing, are ETF mutual funds, which means I am buying baskets of multiple different investments just to stay diverse instead of buying individual stocks. I may buy individual stocks in the future, but that involves a little more risk, and I really have to know what I'm investing into. So yes, it demands more homework on my part, and as a beginning investor, I don't want to risk much right now. Now, the FCPIX fund is heavy international and is more on the emerging side of the international spectrum, so it's a little bit more risky. But given that it's so cheap, it's a good investment right now. This one is a bit more growth focused and more volatile. The second ETF that I invested into is SGIIX, First Eagle Global. This is into heavy international investments and includes China's market. And this one is more average, not super conservative, and not heavy in growth. The third fund that I invested into is the OAKIX, the Oakmark International Investment Fund. This fund is deep value, meaning that it buys cheap, discounted international opportunities in emerging and development sectors of full international. The whole focus of this fund is to buy into companies that have strong positions. So for example, during COVID, airlines and cruise lines all dipped in half because people got scared. But because we aren't going to stop traveling, these came back up. And this is the whole premise of investing into strong companies that are just dipping at times on an international level. So it's more of a conservative international investment. It doesn't have as much China as the previous funds, but still a lot of international. Their asset performance hasn't been incredible historically speaking, but if you keep watching, I'll share why I've chosen to invest in it. The fourth on this list is the GSFT's Columbia Dividend. And this one is a little bit international, but it's focused more on growth. It obviously has some dividends included and generally gives higher returns and is based more in tech. With that, however, it tends to have more volatility. Fifth is NINLX, Neuberger Berman, which also is more centered around growth, resulting in higher returns and is also more in tech, thus having more volatility. The sixth fund that I invested into to get massive growths is JGSX, JP Morgan Growth. And this also is more into growth, having higher returns, focusing more on tech. The seventh investment that gave me massive returns was the KAGIX, Kensington Dynamic, which is a pretty cool tactical investment because depending on where the market is at, it will automatically convert into partial cash that month. So the way it's managed is that it watches for certain performance metrics to balance out as a buffer on the downside. So it provides more protection, but still invests in the market for growth. And lastly, I invested into the 8th ETF, VARBX, which is the First Truster Arbitrage. And this one just sits and buys the difference on a spread in a merger. So if there's a buy-sell between two companies, it's getting a taste of the spread. In the last 20 years, the trust merger arbitrage year over year has never had a down year. So this investment serves as more of like a bond replacement to help get some safer returns without taking as much risk, and generally it's performed better than the regular bond matrix. Most bonds 2 years ago were down 16%. So this fund provides a nice buffer in case we experience a heavier recession than expected. Each of these funds, meticulously selected, has contributed to this impressive growth. Now, you might notice a significant international presence in these funds. The reason behind this is about to unfold. But before we dive into that, let's understand how these investments worked. Last October, the market took a 10.5% dip. This downturn was the perfect opportunity to buy in. Between October 27th and 31st, fortunes were made by those who saw the opportunity and seized it. The market hasn't looked back since then. Instead of witnessing a 10.5% drop and a subsequent 14% rise, resulting in a mere 3% growth, the strategic investment during the downturn resulted in a full 14% growth. The current economy speaks volumes about the resilience of the market. The Consumer Price Index, or CPI, is a measure of the average change in the price of goods and services. It's a significant indicator of inflation. The CPI recently registered at 3.1, higher than the expected 2.8, showing that inflation isn't backing down. This indicates that the interest rates will remain high for a while, as it's the Fed's primary tool to control inflation. Some experts forecast rate cuts around May or June this year, but given the stubborn inflation, it wouldn't be a surprise if the cuts are delayed. Looking back at the history since the 1980s, T-bills, the backbone of high-yield savings, performed the weakest after every Fed pause. They yield around 4.2% to 4.6% in the following 3 years. In contrast, bonds perform around 8.6% to 9.6%, and stocks around 11.1%. This historical performance suggests that leveraging cash or extending duration might be a better strategy than sitting on cash or CDs. Now, the moment of truth. Why the heavy international presence in my investments? The answer is simple. A forecast of a significant climb in international markets in the next 2 to 5 years. This chart is not readily available on the internet, so pay attention to what I'm about to show you. On the left shows the international PE discount versus the US, and you'll notice that it's recently dipped extremely low. In fact, it's dipped over 2 standard deviations below average. That's an insane amount. This means that now is the time to invest internationally, because historically, we definitely will see the market climb back out of this in the next couple years. In fact, historically speaking, it'll be hard to justify not having a climb. So in the end, that's why I pushed heavily into international and am currently continuing to do so. If this information has been valuable to you, do subscribe for more such insights. As always, expect more exciting content next week.